They say inflation is under control. They're lying. The numbers in reality tell a different story. As of March 2025, the Consumer Price Index is still rising, 2.4% year over year. Core inflation, even higher, 2.6%. It's above the Federal Reserve's target. And it's not stopping there. New tariffs 25% on cars and a staggering 145% on Chinese imports are set to push prices even higher. Most Americans already feel it. 74% say inflation has gotten worse over the past year. And they're right. So when they tell you inflation is under control, don't take their word for it. Look at the facts. Prepare accordingly. War, debt, inflation. These aren't isolated events. They're interconnected strategies. Governments often finance wars through borrowing, leading to massive national debts. To manage these debts, they may resort to printing more money, which fuels inflation. This cycle isn't new. History shows that during times of conflict, such as world wars, nations have increased spending, leading to higher debt and subsequent inflation. Today, we're witnessing similar patterns. Understanding this isn't just about economics. It's about safeguarding your financial future. The rich are preparing for a financial and economic crisis. Have you done anything to make sure you are safe? Don't worry, I'm here to help. Are you watching the rich get richer while your savings shrink? Inflation, war, and technology are rewriting the rules of wealth. And most people don't even see it happening. But you will. Today, you will learn how to protect your money and grow it in a world where everything is changing. You're on the passive path. Let's get started. The first thing you need to understand is this. The economy is not what it seems. Politicians and experts say inflation is under control. They're wrong. Inflation isn't going away. It's built into the system now. Why? Governments around the world are drowning in debt. The United States alone owes over $36 trillion. But that's just the official number. The real burden includes over $100 trillion in future promises. Pensions, Social Security, military benefits. Where will the money come from? They will print it, just like they always do. But printing money doesn't create wealth. It destroys the value of your savings. Think about it. When governments create more dollars, every dollar you own buys less. This is why groceries, gas, and housing keep getting more expensive. It's not just bad luck, it's policy. In the stock market, that's another trap. In the past 5 years, over $50 trillion in paper wealth was created, a 40% increase. Sounds good, right? But it's a bubble. Stock prices have been pumped up by cheap money and speculation, not by real growth. Now, interest rates are rising. Bond yields are climbing. That means it's getting more expensive to borrow money. And when borrowing gets expensive, businesses slow down. Home buyers pull back. Stock prices start to fall. We've already seen early signs. The 10-year U.S. bond yield shot up to almost 5%. It was supposed to go down. Instead, it's rising. This is putting pressure on mortgages and the housing market. It's just the beginning. If you're holding cash or stocks thinking they're safe, think again. The world is shifting. The old rules don't apply anymore. The people who understand this are making moves. They're not waiting. They're getting out of risky markets. They're buying real assets. Gold, silver, commodities. Real estate in key areas. Not all real estate. Smart real estate. Assets that hold value even when currencies fall. Ask yourself, what happens if the dollar keeps losing value? What happens if the stock market drops 30%, 40%, or more? Do you have a plan? Most people don't. That's why you need to keep watching, because there's more. The forces driving this economic shift aren't just financial, they're political, and they're global. That's what we'll cover next. Stay with me. Let's talk about what's really driving up your cost of living. Politics, trade wars, global conflicts. You've seen the headlines. Tariffs, sanctions, military tensions. But here's what most people miss. These aren't random events. They're calculated moves in a battle for resources and power. Look at the tariffs between the US and China. Higher tariffs mean higher prices. Not just for big companies. For you, for everyone. When the cost of imported goods rises, businesses pass those costs to consumers. Groceries, electronics, cars, even basic materials like steel and lumber. You pay more. That's inflation. But it's not the only cause. Geopolitical conflicts are making it worse. The war in Ukraine, the tension over Taiwan, the rivalry between the US and China. What do they all have in common? Resources. Control over natural gas, oil, minerals, and technology. When Russia invaded Ukraine, it wasn't just about borders. It was about control of trillions of dollars in natural resources. The same goes for the South China Sea, and the same pressures are building worldwide. Wars and political tensions disrupt supply chains. They reduce the flow of goods. They push up costs. They create uncertainty. Uncertainty makes markets volatile. Investors pull back. Businesses delay spending. Prices swing wildly. But that's not all. There's a deeper danger. Military conflicts are speeding up the global technology race. China is investing heavily in advanced tech, electric cars, batteries, hypersonic missiles, 5G networks, and they are catching up fast. One nation gains a clear tech advantage, they gain military power too. That's why the US is now pouring billions into new industries and research. But here's the catch. This kind of spending adds to government debt, and to pay for it, they print more money, which fuels more inflation. It's a vicious cycle. You've already felt it at the pump, at the grocery store, your rent or mortgage, and there's more ahead. Tariffs are likely to increase. Labor shortages will push wages higher. Rebuilding industries in the US will raise production costs. All of this points to one outcome: higher prices, less purchasing power, unless you position yourself wisely. What does that mean? Avoid depending on fixed incomes or savings in cash. Think about assets that rise with inflation, like commodities, gold, silver, and investments linked to essential goods and services. This is how smart investors stay ahead. They don't just react. They anticipate, they prepare, and they profit. Stay with me, because in the next section we'll explore the biggest financial shift you've never heard of, and why it's coming faster than anyone expected. A silent revolution is happening in money itself. Most people don't see it, but you will. The world is shifting away from cash and toward digital money. Governments call it central bank digital currency, or CBDC. It sounds technical, but the meaning is simple. Cash is disappearing, and every transaction will soon be tracked. China is leading the way. In many cities, people already pay with a scan of their palm. No cash, no credit cards, just digital credits. Other countries are following fast. Why? Because digital money gives governments more control. They can monitor every purchase. They can freeze accounts. They can even limit how or where you spend. This is not science fiction. It's already happening. And while the public debates privacy concerns, the rollout continues. At the same time, technology is disrupting finance in another way. Artificial intelligence. AI is being used to manage trading, loans, and even investment advice. Promises efficiency, but it also concentrates power. A few large banks and tech firms are gaining more control over the flow of money, and small investors are at greater risk of being left behind. The recent boom in AI stocks reminds many experts of the dot-com bubble. In the late 1990s, internet stocks soared. Then they crashed. The same pattern could repeat with AI. Early investors might profit, but many will lose. The wealthy are preparing for this. They are moving out of speculative tech stocks and into assets that hold real value. Gold, silver, Bitcoin, and yes, real estate. But they are selective. Not all properties are equal. They choose locations and sectors likely to grow even in tough times. Japan offers a lesson. In the 1990s, Japan printed trillions of yen, but they kept the currency strong. How? By buying valuable foreign assets. Land, companies, resources. This strategy protected wealth even as debts soared. The United States and other nations are now facing similar choices. Print more money, devalue the currency, and hope to buy enough real assets to stay afloat. But individual savers and small investors can't afford to wait. If you rely on cash or low-yield accounts, you're falling behind. The passive path is not about chasing risky trends. It's about understanding the big picture and acting wisely. In the next part, we'll talk about the biggest risk to your retirement and what you can do about it. Millions of people trust their retirement to 401 kiloseconds and similar plans. They believe these accounts will carry them through their later years. But most don't even know what's inside their portfolio. They follow outdated advice. Buy, hold, and hope. This strategy worked during long periods of growth, but the world has changed, and so have the risks. Many retirement accounts are heavily invested in stocks. Others rely on bonds. Both are under pressure. Stocks have reached dangerously high valuations. Some popular shares are priced for perfection, so any shock could send them falling. Bonds once offered safety, but rising interest rates have changed that. When rates go up, bond prices fall. Retirees who hold these assets could see their savings shrink. And then there's inflation. Even if your investments hold steady, inflation erodes their real value. $1 today will not buy as much tomorrow. Let's not forget disaster stocks. These are shares that collapse without warning. A company may seem strong one day. The next, it announces poor results, legal troubles, or leadership failures. Its stock price drops 20% or more overnight. Investors are left holding the bag. Many refuse to sell. I hope the price will recover. Often it does not. Losses deepen. Some companies never regain their value. Remember the 2022 Southwest Airlines crisis? It canceled thousands of flights due to outdated technology. Their carbon emissions fell, and executives received bonuses for meeting ESG goals. But shareholders suffered. Starbucks faced similar issues. Plans to expand in China ignored geopolitical risks. They also tied executive bonuses to diversity targets. These choices affected profitability, and shareholders paid the price. Now think about the average 401k holder. Most do not track these details. They depend on fund managers. Or worse, they ignore the market entirely. They hope time will fix any problems, but time is not on their side. Delaying action can turn small losses into large ones. The first loss is often the smallest. Holding on to bad investments usually leads to deeper declines. If markets continue to fall, many retirees will see years of savings wiped out. This is not fear-mongering. It is reality. If you depend solely on traditional retirement plans, you are exposed. The passive path means taking control, understanding your holdings, rebalancing when necessary, and diversifying into assets that can withstand inflation and market shocks. In the next section, we'll look at where real wealth is hiding and how smart investors are already taking advantage. Real wealth is not found in paper promises. It's found in real assets. Things you can touch. Things the world cannot do without. Commodities, gold, silver, energy, and essential real estate. These are the assets that protect value when currencies fall and when markets crash. Smart investors know this. That's why they are quietly shifting into commodities. Look at gold. For thousands of years, it has preserved wealth. When inflation rises, when governments print money, when trust in currencies breaks down, gold holds its value. Silver follows a similar path. It's both a precious metal and an industrial metal. As industries grow, demand for silver grows too. Now think about energy, oil, natural gas, and the materials needed for renewable energy. Lithium, copper, rare earth elements. These are the building blocks of modern life. No matter how technology advances, we will need these resources. During the 2020 pandemic, many investors feared a collapse. But those who moved into commodities protected their wealth, as some even grew it. While tech stocks swung wildly, commodity prices climbed steadily. Today, the trend continues. But not all real estate is equal. Office buildings in major cities are losing value. High interest rates and remote work are changing demand. But residential properties in growth areas are still strong. Farmland and resource-rich land are gaining value. Sovereign wealth funds understand this. These are government-run investment funds. They're buying real estate, commodities, infrastructure. They know that printed money loses value, but real assets do not. Billionaires follow the same path. They are not betting everything on stocks or digital currencies. They are spreading their risk, buying land, metals, energy, and businesses tied to essential goods and services. This is not speculation. It is strategy. And it's the strategy you need to learn. The passive path means thinking like the smart money, looking beyond the headlines, and building a portfolio that can withstand the storms ahead. In the next section, I'll show you how to put these ideas into action. Simple, practical steps to protect and grow your wealth, starting now. It's time to focus on action. What can you do to protect and grow your wealth in 2025 and beyond? Start by understanding one key principle. Cash is not safe. Holding large amounts of cash exposes you to inflation. Every month, your purchasing power declines. So what's the alternative? Diversify. Spread your assets across different categories. Here's how. Keep enough cash for short-term needs. 3 to 6 months of expenses is a good rule. Beyond that, think about assets that can keep pace with inflation. Precious metals. Gold and silver have stood the test of time. They're not investments that pay dividends, but they protect value when paper money falls. Commodities. Invest in the essentials the world needs. Energy, food production. Industrial metals, real estate. Focus on properties in growth areas, or sectors tied to essential goods and services. Consider farmland or resource-rich land, things the world cannot do without. Commodities, gold, silver, energy, and essential real estate. These are the assets that protect value when currencies fall and when markets crash. Smart investors know this. That's why they are quietly shifting into commodities. Look at gold. For thousands of years, it has preserved wealth. When inflation rises, when governments print money, when trust in currencies breaks down, gold holds its value. Silver follows a similar path. It's both a precious metal and an industrial metal. As industries grow, demand for silver grows too. Now think about energy, oil, natural gas, and the materials needed for renewable energy. Lithium, copper, rare earth elements. These are the building blocks of modern life. No matter how technology advances, we will need these resources. During the 2020 pandemic, many investors feared a collapse. But those who moved into commodities protected their wealth, as some even grew it. While tech stocks swung wildly, commodity prices climbed steadily. Today, the trend continues. But not all real estate is equal. Office buildings in major cities are losing value. High interest rates and remote work are changing demand. But residential properties in growth areas are still strong. Farmland and resource-rich land are gaining value. Sovereign wealth funds understand this. These are government-run investment funds. They're buying real estate, commodities, infrastructure. They know that printed money loses value, but real assets do not. Billionaires follow the same path. They are not betting everything on stocks or digital currencies. They are spreading their risk, buying land, metals, energy, and businesses tied to essential goods and services. This is not speculation. It is strategy. And it's the strategy you need to learn. The passive path means thinking like the smart money, looking beyond the headlines, and building a portfolio that can withstand the storms ahead. In the next section, I'll show you how to put these ideas into action. Simple, practical steps to protect and grow your wealth, starting now. It's time to focus on action. What can you do to protect and grow your wealth in 2025 and beyond? Start by understanding one key principle. Cash is not safe. Holding large amounts of cash exposes you to inflation. Every month, your purchasing power declines. So what's the alternative? Diversify. Spread your assets across different categories. Here's how. Keep enough cash for short-term needs. 3 to 6 months of expenses is a good rule. Beyond that, think about assets that can keep pace with inflation. Precious metals. Gold and silver have stood the test of time. They're not investments that pay dividends, but they protect value when paper money falls. Commodities. Invest in the essentials the world needs. Energy, food production. Industrial metals, real estate. Focus on properties in growth areas, or sectors tied to essential goods and services. Consider farmland or resource-rich land. Dividend stocks. Select companies with strong balance sheets. Companies that provide essential products or services. Stay away from speculative tech stocks or unproven businesses. Stay liquid. Have some assets that can be easily converted to cash. This allows you to take advantage of opportunities when markets drop. Avoid debt traps. High-interest debt can destroy your wealth faster than inflation. Pay down bad debt. Be cautious with new borrowing, especially if interest rates continue to rise. Don't chase hype. Be skeptical of hot investments. If everyone is rushing into a market, it's often too late. Value matters more than excitement. Study asset allocation models. Consider a mix that suits your risk tolerance. Example, 40% in stocks, 30% in commodities and precious metals, 20% in real estate, 10% in cash and liquid assets. This is just a sample. Your exact mix should reflect your goals and situation. Review your portfolio regularly, at least once a year. Rebalance as needed. Sell assets that have grown to large. Add to areas that have lagged, but still hold promise. Stay informed. Economic trends are shifting fast. Follow reliable sources. Stay alert to changes in inflation, interest rates, and global events. But don't panic. Reacting emotionally can lead to poor decisions. Think long-term. The passive path is about building durable wealth, not chasing quick profits. Prepare for volatility. Markets will rise and fall. Expect it. Plan for it. And use it to your advantage. Finally, take action. The biggest mistake is doing nothing. Waiting often leads to missed opportunities and deeper losses. Start small if you must, but start. The next section will talk about the mindset that separates the wealthy from the rest, why it matters now more than ever. Wealth is not just about money, it's about mindset. The wealthy think differently. That's why they stay ahead. They read trends before the masses. They study the big picture. They don't wait for the news to tell them what to do. They anticipate. They prepare. And when the time comes, they act. The average person reacts emotionally. Fear and greed drive their decisions. This leads to buying high and selling low. The wealthy avoid this trap. They stay calm. They make decisions based on data and strategy. They understand that wealth building takes time. There are no shortcuts. They also embrace flexibility. When conditions change, they adapt. They don't cling to old beliefs or outdated advice. They're not afraid to exit bad investments. They are not afraid to try new opportunities. But they do so with careful thought, not reckless gambling. They value education. The more you learn, the better decisions you make. This is why many of the world's richest people read daily. They seek knowledge. They stay informed. They also understand risk. Every investment carries some risk, but avoiding all risk guarantees failure. Inflation itself is a risk. Holding cash is a risk. Not acting is a risk. The wealthy balance risk and reward. They diversify. They prepare for setbacks. And when opportunities arise, they move quickly. This mindset is not reserved for billionaires. Anyone can adopt it. And you must if you want to thrive in this new economy. Fear-based decisions destroy wealth. Confidence backed by knowledge builds it. That's what the passive path is all about. Building wealth through understanding, taking action early, and staying resilient through change. If you followed this entire video, you are already ahead of most. Now it's time to apply what you've learned. Don't wait for the next crash to wake up. Start building real wealth today. Like this video to support the channel. Subscribe to stay informed. And comment below with your thoughts or questions. Join the Passive Path community. Your future self will thank you. You've now seen the truth behind today's economy. Inflation, debt, war, and technology are reshaping the rules of wealth. But you don't have to be a victim of these changes. You can take control. You can protect your savings. You can grow your wealth, even in uncertain times. The Passive Path is here to guide you every step of the way. If you found value in this video, like it now. Subscribe to the channel so you never miss an update. Comment below and share your thoughts. And most importantly, share this video with someone you care about, someone who needs this knowledge as much as you do. I wish you the best of luck on your financial journey. Feel free to watch other videos on this channel to deepen your understanding. And I'll see you in the next video.